What do P&L statement terms mean for restaurant owners? Imagine trying to run a restaurant without knowing how much money is coming in or going out. It would be like trying to steer a ship without a compass. That's where a profit and loss statement, often called an income statement, comes into play. It's a key tool that shows how your restaurant is performing financially over a certain period. Understanding what each term on this report means can help you make smarter decisions and keep your business profitable. Let's start with revenue. This is the total money your restaurant earns from selling food, drinks, catering, or even merchandise. It's the gross income before subtracting any costs. Next is the cost of goods sold. This covers the direct costs of ingredients and beverages used to make your menu items. For example, if you buy chicken, vegetables, and spices, their total cost is part of COGS. Managing COGS is essential because it directly impacts your profit. If your COGS is too high, your profit shrinks, even if sales are good. Gross profit is what's left after subtracting COGS from revenue. It shows how much money you have to cover other expenses and still make a profit. To see how efficiently you're managing costs, look at the gross profit margin, which is expressed as a percentage. If your gross profit margin is high, it means you're controlling costs well relative to your sales. Labor costs include wages, salaries, taxes, benefits, and tips paid to your staff. Since labor can be a large part of your expenses, keeping it in check is vital. Operating expenses are all other costs needed to run your restaurant, like rent, utilities, marketing, insurance, and maintenance. Some of these are fixed, like rent, which stays the same each month, while others, like advertising, can vary. Prime cost combines your COGS and labor costs. This figure is especially important because these expenses usually make up the largest part of your total costs. Monitoring prime cost helps you see how well your restaurant is performing overall. The bottom line of the P&L statement is your net profit or net loss. If your revenue minus all expenses results in a positive number, your restaurant is making money. If it's negative, you're losing money. Break-even is the point where your total revenue exactly covers all your costs. Knowing this helps you understand how much you need to sell to stay afloat. For restaurant owners, paying close attention to COGS and labor costs is key because they are the biggest and most controllable expenses. Comparing actual costs to your budget can help you adjust staffing levels or negotiate better supplier prices. Tracking gross profit margin regularly allows you to tweak menu prices or portion sizes to improve profitability. Understanding your operating expenses helps identify areas where you might cut costs without hurting customer experience. Using your P&L statement as a forecasting tool can help you plan for seasonal changes or growth opportunities. Since profit margins in the food industry are often slim, mastering these terms and how they relate to your business is essential for keeping your restaurant healthy and growing. With clear knowledge, you can make smarter choices that lead to better financial results.